Okay, good morning everyone. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Thursday, July 28th. Michael Boutros here with you guys. Good to be here with you, Doug, Eileen, Joel, Aurelian, Mark, Mir, Pooja. Got the whole gang today. So good to be with you. We just got the release of initial jobless claims here in the United States coming in at 266,000. Continuing claims right around expectations, slight downward revision to the previous month on the initial jobless claims, continuing claims creeping higher. Not going to be anything of anything of impact for today, guys. Tomorrow is the real, or I guess the last, I should say, event risk for the week. To backtrack a little bit, we'll talk about the dollar index and the impact that the Fed had. Very interesting. We do want to also cover dollar CAD, which has been the trade I've been most involved in all week long. Interesting levels on Aussie Kiwi. As a disclaimer, I haven't taken anything on that yet, but I do think on a drop you want to take a long position on that, so we'll discuss that. Euro dollar, obviously, on the break to the upside of the weekly opening range. We'll check over on crude and gold. Crude coming into near-term support. Gold has a little bit more upside to go. And then we'll take a look at some of the other dollar crosses as we head into tomorrow's major event risk for the United States, at least, and that is the GDP print for the second quarter. Here's what is expected tomorrow. And then we'll go over some of the comments from the Fed. So heading into tomorrow's GDP, we are looking for GDP for the second quarter to come in at 2.6%. Remember, first quarter was exceptionally weak with a print of just 1.1. Personal consumption is expected to also uptick dramatically to 4.3% from 1.5. Most important, and the thing I'll be paying most attention to, is the core PCE, the personal consumption expenditure. As I always note in the webinars here, guys, this is the Fed's preferred gauge of inflation as opposed to the headline CPI numbers. So here, the interesting thing is we are expecting a downtick. Remember, 2 to 3% is the Fed's goal on inflation. We're expecting PCE, core PCE, which strips out food and energy, to downtick by 0.3% to 1.7. With that said, okay, if it comes in at 1.7, that's not going to be interpreted as necessarily super bearish for the dollar because we are expecting the print to be weak. The risk is if we actually come in stronger than 1.7, say a 1.8 or a 1.9, you could see a little bit of a rebound for the dollar. Broadly speaking, we'll go over the dollar levels in a moment. We're still looking lower, but just keep that in mind. You know, you might not get the biggest play off the GDP read. It might actually be more so off of the inflation gauge. They're released at the same time at 8:30 Eastern. Obviously on SB Squawk, I'll release those the second they come out, but keep that in mind. So for the dollar index, or before we jump into that, for yesterday's Fed meeting, you know, you did see them hold rates. Major commentary that I took away, I guess, from the Fed was the fact that downside pressures have diminished or are diminishing. And that basically suggests that they're saying, okay, look, the economic data is starting to turn more positive, but still they remain reluctant. Okay, here's some highlights. Jobs data points to some increase in labor market utilization, and near-term risks for the economic outlook have diminished. These two highlighted comments that you see here on the Bloomberg terminal are what flooded the headlines on the release. Okay, interesting thing, as we noted earlier in the week when we were talking about New Zealand and how the New Zealand trade balance data was absolutely dismal, much weaker than expected, and Kiwi ripped. It's all about the condition that the market is in. These releases, and I'll say this time and time again, because actually the interesting is I got a flood of some of the interns, both for SB and Daily FX, coming up and saying, well, what gives? Why is the dollar, you know, falling off if this is more hawkish? And it's all about what the market is primed to do. Sometimes these releases are just the trigger for the next move. It's not necessarily going to dictate near-term price action. With that said, I think everyone would agree with me if we're just looking at this objectively and we're just sort of following Fed policy, it looks a little bit less dovish, dare I say, more hawkish. With that in mind, here's what the overnight index swaps are looking like, Fed Fund futures. Okay, and we went over this. I actually tweeted this yesterday, but Here's a chart that highlighted the difference that we saw pre-FOMC and right after FOMC. And you could see, interestingly enough, guys, right after FOMC, these actually dropped dramatically. The first 50% plus probability of rate hike dropped till March, or what is that, May. And then shortly after, it came back into March. But the story being, markets are not buying what the Fed is selling. Okay, this is essentially telling you that despite the fact that the Fed still says there's room for an interest rate hike this year, despite that they're coming out with a little bit more, like I said, less dovish commentary, didn't budge the market, and the market's not buying it. As is, this was the reaction that you saw in the dollar index. It rallied right through. Again, I'll bring your attention really quick to this long-standing trend line, former support, extrapolated off the high here from July of 2013. Really nice pivots, former resistance. High day close comes in at 12,102. We talked about that yesterday. Excuse me. We probed right through that on the release, and then posted a massive reversal that took us lower on this session. That's bearish. Momentum unable to make any progress above 60, and in fact making some divergence here with these last two highs in momentum as price action made higher highs. And then you have a reversal day like this, you look lower. Now, the play yesterday is done. Where do we go from here, Mike? This is all good and dandy from a story standpoint, but how do we trade this from here? So you're coming into a major support barrier near term. That's 12,017 into 12,028. We were looking at that early in the week, right? This is the close for that June 27th rally. Really nice pivot in price if you just go back, okay, as far as the 12,030 level is concerned. And then you have a basic 236 at 12,017. The 200-day moving average right here in green is also right there at this point. So sure, yeah, a little bit more upside to go, no problem. A bounce even maybe to test those former opening range lows for the week, 1260, sure. But you stay bearish essentially below this median line. Today's close will be important. If today's close is above yesterday's open, which was 12,052, or you close above that median line, essentially you do risk tomorrow's GDP print giving you another push here before you move lower. Broadly speaking, 12,102 is our bearish invalidation. As long as we stay below that, we're going to continue favoring the short side in the dollar. A break below here, targets are very clear. Your monthly open comes in at 11,997. And then you have confluence support down here with the 50 line, a basic 38.2 retracement of the advance off the Brexit low, and the monthly opening range low, all stack up at 11,953. So the levels are super clear on the dollar index, finally starting to get some play here. If you guys remember, we were in this chop fest for the first, 2 weeks of the month where this thing wasn't doing jack. Finally getting that exhaustion trade. We've been looking for this exhaustion trade for some time here. So looks like it's starting to pan out. Don't get too excited yet. We really do want to see it close below the median line here to get this going. Again, turning ahead of that 50 line, even more conviction that this thing is ready for a little bit more of a backtrack trade lower. All right. Any questions on the dollar index? Whoops. Tomorrow's data print, or any of the expectations from the Fed moving forward? As it stands right now, heading into the U.S. session, you do have the dollar weaker against all its major counterparts, save the British pound. We'll take a look at that in a bit. Not really a big fan of trading the pound right now. I think the breakout yesterday was phenomenal, but we'll go over that later. Yen, biggest performer. Remember, you do have the BOJ on tap later tonight. Australian dollar, big data early next week with the RBA on the 2nd of August. That's up 0.48%. And then interesting moves on the Swissy. Actually, we'll also take a look at that. Dollar Swiss coming back down into near-term support. Okay, so that is the dollar index. Let's jump into yesterday's scalp report and we will jump into a little bit more of the metrics. Dollar CAD was up first, and like I said, Dollar CAD has been the trade for me, at least this week. I've been all up and down. Yesterday's FOMC release was actually a beautiful short. I booked 72 pips on the decline on that one, really on an exhaustion trade. And I'll show you the near-term chart in a moment, but it was a really nice trade as far as the exhaustion, inability to break above that median line, dollar weakness on the report, and it was one of those trades where we discussed yesterday in the webinar, guys, the game plan moving into FOMC was to look to fade dollar strength. And you got that opportunity on a lot of different trades. The pound slammed lower. That was an opportunity to get long, ripped. Biggest mover was actually the Kiwi, which also did a wicked reversal. For me, dollar CAD was where I tried to play most of that. So the daily chart hasn't really changed from yesterday. I don't want to spend too much time on this so I can get through as many as I can today. But the only thing I really want to highlight here is 31.03 into 31.21. That's exactly where we were last night, and I tried to highlight that as far as a key support region and where we would look to find some support or a rebound play for dollar CAD. You got the rebound in overnight trade, okay? The pullback came right into that region. Remember, you had the May high day close, the weekly open, this lower parallel for a really short-term slope, and former trendline resistance just off the May highs, all stacked up in this region. So you came in overnight. Here was the exhaustion trade. Again, momentum holding 60 resistance like a stone wall, even on that spike. And then again, the drop off here coming into support overnight, saw a rebound. We're sort of dilly-dallying right around this 31.60, which was the first initial resistance target. Here's what it looks like on the 30-minute. There you go. So you can see pretty clean as far as price action is concerned. You did get that last spill here into the open of London trade into 31.03, but this was the bullish invalidation level. You saw a really strong reaction there, and that keeps the focus really weighted to the upside while above that same region, 31.03 into 31.21. Now, as far as topside targets are concerned, 31.88 becomes the level of significance. Yesterday, we were looking at 31.86. Which is also a level that was the previous high day close. The new high day close is 31.88. It's only 2 pips. But long story short, this is the first initial resistance we need to get through. And this is a level of which, if we clear, for me, even ahead of the highs, would be considered a breakout zone. That's like 32.20. Okay? And you're basically looking at former channel support. Really well defined. 1, 2, 3, 4 tags before breaking. May offer some resistance, and again, if we break higher, would invalidate this decline. And then you have longer standing, the median line that we were talking about on the daily chart. And you can see that converges on that region too. All right, so for dollar CAD, no change. Bullish invalidation, key support still 31 to 31.20, near-term resistance 31.80, and a break above 32.20 really validates a larger ascent to the upside. The major key region of resistance, by the way, if we do get the topside break, is 33.12 into 32.95. It is stacked with technical resistance. I think we went over this yesterday as well, but just for a quick reminder, a basic 38.2 of the entire 2016 range, the 324 swing high, that's just the first of it, but you also have the 200-day moving average in there. And that all stacks up right around straddling that 33 handle. Looking for more shorts from here then, or waiting for it to go higher yet for shorts in dollar CAD? So Eileen, maybe I'm not explaining it right. I'm still constructive dollar CAD, right? If you guys recall, oh, I think I know where you're asking that because of last night's short. The short we took yesterday was an exhaustion trade off of the opening range high for the week. And you also saw mass dollar weakness. And broadly speaking, momentum couldn't hold a bullish formation at all. I mean, we couldn't, even ahead of that on the rallies, 60 resistance, 60 resistance, 60 resistance. Really didn't have any push behind it. So no, for me, the short side of the trade is done. That was yesterday. I took out target way ahead of this break. I took out target on this dip. In fact, I had my limit right on the inside of this. It was, again, sometimes it's better being lucky than skillful, but Either way, it would have gotten triggered later in the session. Missed out on this decline. Really, for me, I'm still looking to play the long side. Remember, we just came off of a big support. Classic technical analysis, Eileen. Break of resistance, check it as support, move off. So as long as we hold above this region, I'd be looking for long triggers. So how to trade this from here on out, looking at the US session, I'd be looking for either a drop back into this region for a possible long exposure, or if we break resistance, I want to see a pullback, and then again, we'd start to look for a long exposure. Don't get me wrong, there might be an opportunity to short this against the upper median line, but that would be counter trend, right? Because the breakout that we're working under, the assumption is that we just came through resistance, checked it as support, and moving off. Keep also in mind that this is the weekly open, and that's a pretty strong defense of the weekly open. Okay, my only problem with this trade is the fact that if the dollar breaks support on the dollar index, now keep in mind that the loonie is not represented in this Dow Jones FXCM dollar index, but if dollar index does break support and you do see a little bit more of a mass dollar sweep out, I think dollar CAD might kind of just go sideways to lower near term. That's my only problem. That being said, Eileen, with the dollar index coming off support, I wouldn't even be surprised to see this rally a little bit and then come off. That would give us dollar CAD to take a little bit more of a stretch higher into that key resistance, and then if possible, from there we might look lower. Eileen, does that make sense for dollar CAD? It says, okay, thanks, makes sense. Right on. Right on. In fact, let's see if there's anything near term here on dollar CAD that we could work with. So yeah, even if you look at this 1 minute chart, and this is just real near-term stuff, guys, I like to take into consideration. This could be interpreted as 1, 2, 3, 4, 5, which would give us indication, again, broader trend, directional trend remains weighted to the upside. As far as the correction is concerned, I wouldn't be surprised if you get a 1, 2, 3, maybe 2 equal legs down. Bottom line is look for this thing to drop again and look for some support on a downside move. Bear with me 1 second. This is real near term as well. I just want to see what this looks like. That would put the 100 at like 31.30. Oh, possible area where maybe start to look for some support, possible long exposure. Okay, so that is dollar CAD. Still like the long side while above 31.03, 31.21. We got that. Next up on tap from last night was Aussie Kiwi. I highlighted this one on Daily FX as well. Like I said, I haven't taken any positions on it yet, but just such a major position from where we are on the broader trade. Here's what Aussie Kiwi looks like on the daily chart first. I know all of you have seen this chart, but I'm going to keep showing it to you because it's so important. Basic trendline support off the 2014 low, the major slope we've been following for over 2 years. Extrapolate that off the lows from last year, caught the lows here this month. On the rally, taking into resistance that same slope extending off of this year's, or last year's October low. Support, resistance. So certainly by all means and by all measures, this slope remains the slope of influence here for Aussie Kiwi, and it keeps the focus broadly higher still. This is uptrend support, uptrend support, uptrend support, uptrend support, right? So you even had some strong building divergence into that low. That's a month-long divergent signal as price action continued to make lower lows, lower lows, lower lows, lower lows. The oscillator continued to make a series of higher lows, breaking through 50, even topping 60 on the rally here. I'm saying all this to you guys right now just to let you know, again, this to me suggests a major low may have been put in place. I don't know if it's going to be the yearly low. I'm not going to make that call at this point, but certainly price action on the near term since that low was made on the 8th has been super constructive. So what does that mean? The focus remains higher. above 105.41. Okay, you have the January lows, which is your initial yearly opening range low, okay, which you broke above. You had the initial monthly opening range high, which we broke above, and a basic 50% retracement of the entire Brexit recovery, all coincide at 105.40, 105.39. Okay, so this is sort of for me a key area of which I would love to see this thing find some support. It might be a nice launching point to take the next leg higher. Bullish invalidation. What would invalidate that thought process for me would be a break below 104.95. Basically, a move sub 105 for me would invalidate this breakout. So you're looking for a drop into this zone to get long, or if it doesn't give us that drop, it just breaks through resistance, a pullback into the 2016 open, excuse me, would be an opportunity again to take a long position. I think this thing gets into 108.25, even 109.45 within the next couple of months. That's just my humble opinion. But just to keep into account, again, the broader key structure here that we're looking for on Aussie Key and how really significant this level is. Bear with me one sec, guys. Okay. Here's what the 30-minute looks like. So within the confines of just the near-term decline, and I want to bring your attention to a basic trendline support that we've been following, which for some reason shifted. There we go. Off the lows that we made for the month. Here's the opening range high for the month. Here's the 50% retracement of the monthly range. Here's the formation that we're currently trading within. As I said in yesterday's piece, kind of sitting right along that median line. Risk did weigh up to the upside as it got some divergence here into late night last night. Here's the rally kind of now sitting on the 50 line. Bullish invalidation is still at the yearly open. Interestingly enough, guys, the weekly open comes in just above 106.65. So this is sort of your key region of resistance of which you need to see a breakout to get the upside going. I still think you're at risk near term for a pull lower first. At least from a trading standpoint, that would be sort of the preferred scenario to get a little bit more of a key support underneath you before you start fighting the decline. But definitely something we'll be keeping on the radar here heading into the end of the month. Could you show the bullish invalidation for Aussie Kiwi again? Sure. For me, it's this 1618 extension. 104.95 right here. Why 104.95, Stephen? You might be asking, man. This is a 1618 extension of the decline. Okay, but it's also the swing low that you made here for what was that? October? Yeah, October. So if we break below that, two things are going to be it's going to necessitate two things, Stephen. It's going to mean that we're going to break this descending channel formation and this descending median line formation, and it means that we're going to have to break sub that 105 key 40 level. So for that to happen, next downside target would be this region right here, and that's the bullish invalidation level. Last ditch effort for this thing to show us some support. Does that make sense, Stephen? He says yes, thank you. All right, cool. Right on. So that's Aussie Key. Looking for some near-term support to get long. If we don't get the pullback and you get the breakout of the formation, look for a pullback to get long. But the end of the story is constructive above 105.40, bullish invalidation 104.95. All right. I'm going to just take a quick segue to Aussie Yen. Right ahead of the dollar pairs. Here's what Aussie Yen looks like. This is a trade that we've been following here as well. I just wanted to highlight a few things. That basic trendline support off the low is still what I'm focused on. Okay, remember on this trade, we're working under the same assumption. We're staying constructive above 77.61. You have the median line here for the broader formation we've been in for over a year. You have a basic 38.2 of the rally off the low. You have a 618 extension from the ascent off the low, and they all converge right here. So basically, as long as it stays above this region, even if you get the break of this medium-term trend line, I'd be looking for some support down here and possible exposure on the long side for Aussie Yen. Again, RBA on tap on Monday, so keep that in mind. From the near-term standpoint, here's what it looks like. Starting to get a little messy here. Again, I'm not sure why my lines keep snapping out, but here we go. Keeps the focus still. Actually, don't need that at this point. I actually wouldn't even use this at this point either. 618. And let's just see what this retracement looks like off the highs. Okay, little messy, but these are basically the levels I wanted to highlight. Is the only thing this has done is made a weekly opening range, high at 79.70, a low right at that trendline support, and you're basically looking for it. If we get the downside break of this slope, again, I'd be looking for that drop into key support to finally offer some long positions, but not really much going on here in the near term. You can see that for the last couple of days, it's sort of just been zigzag sideways. And that's broadly on account of the fact that you're seeing some Aussie strength, but you're also seeing some yen strength. So the cross is not going to be all that intuitive or not that clear near term. But as we always note, guys, when volatility starts to contract, when price action goes into consolidation, you get a contraction of the range. Typically, that precedes a major breakout play. So for Aussie Yen, keep your eye on that daily chart. Any questions on Aussie Yen ahead of RBA next week and the BOJ tonight? Okay. Next up on tap, let's jump in some of the radar charts from last night. There were quite a few, but there's a lot of stuff that we're looking at. So we went over the dollar levels already. So I don't want to stress that. Remember the key support that we talked about. Watch for the close today above the median line. Here's what euro dollar looked like yesterday. Here's what it looks like right now. So yesterday we posted an outside day reversal off of key support. This is when it matters. We talk about these things in the webinars as often as we can. When we see these outside day reversals, when they matter and when they don't. The last time we saw an outside day reversal in euro dollar was at the monthly high. We spiked right into a major key resistance zone on a massive outside day reversal, and the market continued to move lower into the latter part of the month. Yesterday, again, decline took out the weekly or the previous session's lows, massive outside day reversal, shifted the focus higher. We noted that yesterday. Initial resistance was right here. The high day close for the month, guys, comes in at 110.75, and that's exactly where the 200-day moving average is. We soared right through it, and now testing, the monthly open at 111.06. As I noted yesterday in the radar chart, we need a break above 111.06 on a close basis to fuel the next leg higher. If we do clear this level right here, in my mind, that would be the validation that we would need for the reversal on the euro. Subsequent topside targets, you're looking at 111.70. It's 50% basic retracement, and also we kind of tested that earlier in the month, backed very closely by that 50 line off the high. So for the euro, progressing well. Yesterday we noted our bullish invalidation level at 109.70, I believe, which was the weekly open. At this point, I'm ready to bring that up just a tad. and I'm ready to bring that up to the weekly opening range high, which comes in at 110.30. Interestingly enough, if you take a retracement, look where the 50 comes in, 110.35. So this region right here is where I'd like to see some more stringent support. If you look to the left here in your chart, you can see broadly that region has been a very decent pivot in price with a lot of wicks, both on the south side and the north side. So for the euro, we're going to go ahead and bring up that bullish invalidation near term to that 110.35 level. And again, you're basically looking for a push through this monthly open on a closed basis to really validate a much more significant topside break in euro dollar. Initial targets would be 111.70. Okay, near term, don't be surprised to see this thing giving us a pullback. Eileen, perfect. She's saying, where are you looking for pullback areas for long? So for me, ideal scenario would be for the U.S. session to give us a pullback into this region right here, in which you start to look for some support or some long triggers to try to see if we can close the session above the monthly high. For me, Eileen, to be completely frank with you, I'm not really looking to play euro dollar today. I think you wait for GDP numbers tomorrow and see if you get a more mean, more stern pullback here to offer a long position. But I did want to highlight the key levels as we head into that event risk. For me, this is sort of not on the menu for today. I'll still be focused on dollar CAD. I'll still be looking to see if we get the breakdown in Aussie Kiwi. We'll go over Aussie Dollar. Even that's on the menu. But for euro, if you're not already long, you know, I can't really get excited about getting long up here. Okay, makes sense for tomorrow, says Eileen. Yeah, I think that's the best thing to do from a near-term standpoint, Eileen. I know that on the swing side of things, Jamie has a pending order, guys, for long at 110.31. Same exact level. I just noticed that. It's the same exact level that we're talking about here. Huge pivot. So same thing that Jamie's looking at is what we're focused on here on the near term. Now, heading into the BOJ, Eileen, if you do want to get involved in a euro cross, euro yen is still very much a viable pair to trade. Here's what that one looks like. We've been following this one as well. You can find all the previous ones, guys, obviously, by looking at the latest intraday updates. Just scroll down. You can see all the pairs that are highlighted for each report. Here's the last time we looked at euro yen was the breakdown, okay, that we saw below channel support back on the 25th. Took down all those downside targets into the monthly open, and that's where we reversed. Literally. Super clean trade. Okay, so we took down all those downside targets. We found some support there. A rebound took us right into a newly identified slope resistance, which we capped out on the advance yesterday. Again, the pullback here, still sticking pretty tight to that upper parallel. Okay, on this trade, again, still like the long side. Broadly speaking, as we were talking about on the daily chart, this was the bullish invalidation level. You had the monthly open. You had the initial monthly opening range high. You had former slope support, turned support again since we broke above it, now support. So I'd like to stay constructive on this. And depending on what the BOJ does tonight, you know, there's a lot of talk that they're going to have to start the easing process. There's even been talk. This all started with the meeting that they had with Bernanke and the whole talk about helicopter money. There's even some programs suggesting that there'd be a subsidy for low-income, you know, workers, where literally they're just going to go out and hand out cash. Whatever the case may be, I'm not going to sit there and read, you know, pages and pages and pages of economic data. The price, for me, suggests that yen weakness is still the broader story you want. So if you get a jackknife lower on the yen crosses, some yen strength temporarily, you know, I do think that you still look to possibly fade that. And with what the euro is doing on the breakout, I think euro yen is a good option on a topside break. Excuse me. Hand out cash. I'll stand out there if I know they're coming. Better to watch for pips. Yeah, I mean, it's the BOJ's really stuck between a rock and a hard place. I laugh about it, but there's really no easy out. And now they're right back in this situation where it's a race to the bottom. All these central banks across the globe are still looking to increase their accommodative measures, make more stimulus measures that'll stoke economic activity. Meanwhile, the Fed is sitting here saying, oh, we'll still have, still got room for a hike this year. Keep in mind, there is no Fed decision in August. The next Fed decision is in September, and that's a quarterly meeting, meaning we get the quarterly projections as it pertains to unemployment, growth, and inflation, and we also get the presser with Janet Yellen. Typically speaking, on average, it's during these quarterly meetings that the Fed is more likely, more prone to really actually move on policy, because it gives them the opportunity to have the presser where they can better relay the outlook for policy moving forward and take questions from the media. But it really, it's a split decision, as you saw in the credit in the Fed fund futures. For next month, the markets are not really pricing in anything. Okay, remember this chart. 28% chance for a hike in September. Just 28. And December, which is what everyone's pushing for, and in my humble opinion, if they are going to do it in 2016, it's more likely to be in December, just like they did last year, just so they can stick to their words and show face, say that they were going to do the rate hike, and they do it. 25 basis points unlikely to unhinge the markets per se, but certainly if they want to save face and maintain credibility, if they're going to do it, it's more likely to be in December, and you can see that the markets are factoring that in as well, about 47.8%. I don't know how we got back on the Fed discussion, but because we were talking about the BOJ. So keep your eyes on the BOJ, Euro Yen, Aussie Yen, both of interest for me as a possible play tonight. Okay, we went over Euro Dollar. Okay, I want to go over some of the commodity block. We're doing well on time here. Crude and gold, both of extreme great interest right now. Look. Okay, sorry about that. Give me a second. Hey, my friend Kelly G is back in the room, went on a holiday and missed our mornings together. LOL. Let's have a great August and beyond now that I am refreshed. Kelly, welcome back. It's great to see you in the room. Always a pleasure having you back. Where are you looking for long entries on Euro Yen? So for Euro Yen, a long entry for me would be ideally, where's my circle? There it is. Ideally, you get a pull back into here and look to play the long, or you get a break above the weekly open, a break above the median line resistance, and then come back and check at a support, at which case, again, there we'd be looking to play the long for subsequent topside targets. So for me, it's either a downside move here to get long or a break and a pullback here to get long. From an intraday standpoint, you might have an opportunity if we get a stretch higher and a failure here near term to play a short scalp. Again, that would be half leverage because you're going against the trend. But that's sort of the game plan for me, Eileen, for Euro Yen moving forward. Probably want to stay light as light as you can heading into the BOJ announcement. Remember, they don't give you a specific time. They kind of just roll out whenever they want. But that is on tap tonight. Yeah, you're more than welcome. My pleasure. Here's what oil looks like. So we finally came into the key support range that we've been talking about for weeks and weeks and weeks, 41.09 to 41.86. We're checking it as support right now. We came into this level yesterday. Just wanted to highlight that on the radar charts from last night. Okay, here's what crude looks like. And this is a pretty big support barrier near term, guys. So I'm not looking for any additional short scalps from here. If anything, you're looking for some exhaustion lows. Remember, this now, I mean, we obviously are still trading today, but previously this is a 1, 2, 3, 4, 5-day consecutive decline. The last time we saw a 5-day decline was here, was actually a 6-day decline. You saw a really strong rebound. So just keep in mind, you know, momentum is starting to flatten out. You're at support. If you take a basic trend line just off that swing high from the 24th of last month, which is, you know, obviously the Brexit trade, you can see that take that same parallel off the low from last month, basically caught the exact low we just made. Okay. So look for some support, basically is what I'm saying. You could get a rebound off this level. This was the major support we were talking about, if you guys remember, since the start of the month and the opening range break that we made to the downside here. So I'd be looking for some near-term support, bullish invalidation, or I would put still key near-term resistance right at the lows that we made here, 44.40. Bearish invalidation, I'd still put at 45.98. Essentially, the May open. Not so much because it's the May open, guys, but because also you've had such a clean pivot here. Here was the May open, really strong opening range for the month that we broke on the 12th of May. Gave us a topside stretch into the close of the month. Last night was a wash. We never broke the monthly opening range. Here's the downside break. And again, all pivoting around that 46 handle, 45.98. So for me, this is the bearish invalidation. As long as you stay below that, you want to be looking lower. Near term, you are at support. All right. And remember, if there is a link here, guys, above, it just means that there's a previous chart if you want to review it. Here's what the previous chart for crude looked like that we published back on the, what day was this? 25th? As we were sitting in this formation. Again, the downside break, major key support. I'm testing that right now. Okay, and that is crude. Last but not least of the com block, at least, is gold. And I just wanted to highlight that support that we talked about earlier in the week did finally charge a rebound. And we're getting that rebound right now. The level was, or basically we were looking at this former upper median line parallel resistance, now support, and a basic trendline support off of last month's low. Really kind of caught the lows on the decline from 2011, the record high trendline resistance that we failed at earlier in the month. So long story short, from here, the rally is coming into near-term slope resistance. You could get a little bit of a pullback from here. I do think it possibly stretches higher into 1355, but I would be looking for short exposure up there. Okay, again, right along the trend line resistance dating back to the record high. And this is also now the yearly high day close, 1355. Interestingly enough, if you take a little bit closer of a near-term price action here, or a picture rather, on gold, a basic 618 retracement of the decline comes in just below that high day close at 1350. So you have a key range here, 1350, 1355, looking for that rally to find some exhaustion into that region. So really, really clean levels. On the downside, if we get through trendline support, you still want to respect 1303, 1308, which is what we talked about earlier in the week. The high that we made back in May, the 38.2 retracement, might be an area of which it would cause some inflection, but broadly speaking, we're looking for exhaustion on this rally higher in gold. Any questions on bullion prices? Excuse me. Again, I just want to note to everyone, this is the last webinar for the week. You're heading into the weekly close tomorrow. You're heading into the July close tomorrow. These end-of-month flows can really skew and make some radical price action on the intraday. So if you are going to be trading over the next 48 hours, do yourself a favor and just lower your leverage a little bit, especially if you're going to be trading tomorrow's GDP announcement. With thin liquidity conditions, you're in the summer months, and it's the end of the month and week, could offer, like I said, some pretty erratic price action on the intraday. Going right along with some dollar crosses ahead of tomorrow's GDP release for the United States, here's a couple of things that you might want to keep in mind. Here's the British pound. Again, I know that on swing side of trades, we do have an order out for the pound at 131.83. Here's my interpretation of the pound. For me, this has been a little bit more of a sideways trade on the daily prospect. Here's what the 30-minute looks like since the start of the week. So the only thing I don't like right now is the fact that you made a break of the weekly opening range. I saw this yesterday, got super excited, and I was like, all right, awesome. We're finally getting the upside move in the pound. I want to be long. I didn't take anything on it because I missed the initial break of the weekly open high here, but I was looking for the pullback here to find some support along this median line, and I would have loved to take a long position. Obviously happened in European trade, so I wasn't around. Good thing I wasn't, because it doesn't look like the slope is offering much. It did catch the highs, but the median line's not being respected too much, and we're back below the weekly opening range high. So what gives? I don't know. I'd be looking for some support right around those same levels of the lower parallel here. So basically where we bottomed out in European trade, 31.30 into 31.25 or so. But if that doesn't, hold, I really don't have a clear picture on the pound. Okay, so I don't know if tomorrow's GDP print is going to be a player I'll want to take onto the pound. In the event of dollar weakness, I do like the pound long as one of my preferred trades. In the event of dollar strength, dollar CAD's going to be my go-to for that scenario. Going right around the horn, the Swissy, I think, is a lot more of an interesting trade. Starting off with the daily chart, I think, is where you want to focus on that. Here's what dollar Swiss looks like. All right. So, as I said at the top of the webinar, this is coming in some near-term support here. And just to take a sort of look back, a broader look back, this thing came off of an exact tag of the 618 retracement. I know this is not off the high, but this is taking into account all of 2016 trades. So if you just take the 2016 range into account, you can see that the 618 offered resistance here in May, and again resistance here in July. Now, if this slope is operative, and I do like working with this slope both on the account of the fact that we found support along the lower parallel and resistance along the upper parallel, if this gives out, it would shift the broader focus to the downside here for dollar Swiss. Okay, I do think you inevitably do get the breakout. You're at support right now, so you could see this thing find a little bit of a rebound. I am looking lower, below the 200-day moving average, i.e. yesterday's close. That's right around 95.59. And note that you had momentum divergence into those highs. All right, price action making a much sterner high, the oscillator holding highs. So watch for this thing to really fall apart if you do see the downside break, and it kind of matches well with what we're looking at with the euro, right? Coming in some near-term resistance, we'll be looking for that topside break to really open up a much larger gain or rally in the euro, and that would sort of translate well into dollar Swiss weakness, Swissy strength. Okay, and that is dollar Swiss. Any questions on the Swissy? Here's what it looks like on the 30-minute chart. A little bit of messy and near-term price action. If you guys remember, we were working with this slope, I think a few weeks ago, not last week. And there's the initial break of the weekly opening range low. Not only was it a break of the low, we even came back and tested it as resistance. okay, and moved off into the April highs. So like I said, near-term support is here. You stay bearish below 98.50, 98.60 essentially, and you look for a move lower to test really the monthly open at 97.60 would be the next downside target. But leave some room for a rebound here near term. Last but not least, Aussie dollar. Here's what Aussie looks like now. All right. What a wicked trade last night on FOMC. I don't know what to tell you guys. I hope you guys didn't get caught. If you recall, the bearish invalidation, or the bullish invalidation level was 74.46 into 74.50. The monthly open and a 618 key retracement, right where last week's low was. Well, this spike probably took anyone out who was looking to maintain a long play. Just because it dropped so low. It got down as low as 74.20, another 20 pips to the downside before quickly reversing. Note a couple of things. You didn't get a 30-minute close below that. You didn't get an hourly close below that. Momentum was marking divergence all along the lows. Price action making a lower low, the oscillator holding lows. That's divergence still. And again, on the fade for the FOMC, on the jackknife higher, it was a really quick move, so I don't blame you if you didn't get a chance to get in. I certainly didn't on this specific move. Like I said, I played it by way of dollar CAD instead, but it's the same setup, guys. This thing just came right into the weekly high, 50% retracement, near-term resistance. On the immediate approach, I do want to just take a look at the range off the low here. And this is going to be super messy too, but just bear with me. I want to see what this looks like. Might be in play. I'll leave it there for now. I don't want to stress this slope of influence just yet. I just want to see if we get any play sort of along that near-term level right there. But long story short, look, guys, I'm still constructive on the Aussie. I know that fake out yesterday did technically go through the invalidation level, but we closed well above it. Again, the daily chart's pretty clear here. Remember, you had basic trendline support off that low from May. You had the monthly open, which came in at 74.50. You had last week's low. Long story short, you're still within the weekly range. Key resistance and the level we need to beat on the upside is still 75.75 into 75.71. 618 retracement and the high day close for the month. So still looking to buy pullbacks here in Aussie dollar. Like I said, near-term support, you're right there right now, 75.18. A break lower, I'd be looking more for long exposure near this region. Basic trend line, like we said, off the May lows, the 50% retracement off the advance from the weekly low, and even the 50 line for the current operative slope off the lows all converges in this region. And there's key resistance, 75.71 into 75.75. Any questions on Aussie dollar? Again, RBA on tap early next week. As far as the RBA is concerned, by the way, a quick reminder that market expectations are highly factoring in the probability of an interest rate hike over the next, or cut, over the next few months. For next week on the 2nd, looks like market participants toned down a little bit. It's down to 60% essentially, 59.7% probability of a rate cut next week. As you can see, as you get further out in time, the probabilities just keep going higher. Remember also yesterday we looked at the Credit Suisse overnight swaps, which suggests that there's going to be more than one hike cut over the next 12 months. Remember, there are record lows already. This is showing a 61% chance markets are looking for a cut of 25 basis points next week. But if you look at the expectations for the 12-month, they're still looking for 41 basis points in cuts. So my point of showing this to you, again, like I said yesterday, is not necessarily that this has to be bearish, the Aussie. What I'm trying to tell you guys is it's being priced in. This is largely priced in. If Aussie dollar is trading at these levels and you look at these overnight index swaps and Fed fund futures and they're showing these percentages, it shows that, yeah, the market's largely pricing this move in. Now, if we get the cut, doesn't mean the Aussie's not going to drop off. It might drop off, but it's not going to be the sell-off everyone would expect because we are largely pricing it in as we speak. All right. All right, and that pretty much covers everything I had on the list for today, guys. If you have any specific questions or pairs that you would like to review, feel free to post those now. Mir wants to look at Kiwi. Sure. Oh, how did I forget Kiwi? Here's what Kiwi looks like. All right. So we've been following this one exceptionally closely as well. If you go to the intraday page, in fact, Kiwi dollar was highlighted here on the 26th. And here's what that looked like. Okay, so let me bring up the 30-minute chart. So we were looking at the initial weekly opening range. Let me zoom out just a little bit for Kiwi dollar. Just to give things in perspective and to answer your question real quick, I'm actually looking for a rally to sell here in Kiwi. But here's what I wanted to say. We start off the week talking about this initial weekly opening range and the topside break. In fact, the first update for this was even previous, was on the 25th, where we talked about there was the opening range right here. A topside break, we were looking for a rally into 70.68 and the median line. We got that. Here's what it looked like on, whoops. Here's what it looked like on the subsequent day, right? We got that topside break, ran into the median line, and we said, look, the focus range is on this. We stay constructive above the initial weekly opening range high. Basically, that 70.13 level. Well, we saw a downside break. It came right into 70.13, turned out to be an exact 618 retracement of the advance, and then we rallied through that resistance. Topside target at the 38.2, 70.94 is already taken. Now I'm looking for a rally towards 71.38. I think that might be a region of which I'd start to look for a little bit more stringent resistance. Why? It is the monthly open. Okay, it is a 50% retracement of the entire decline. And you also had the 50 line right there, which offered a really nice pivot a couple weeks ago. Okay, so that gives you a range essentially of 71.30 into 71.38 as near-term resistance. So for me, I'd be looking for either a short off that level. You know, if you get another opportunity, this thing comes back into slope support, you might get an opportunity to get a long, again, trying to tag that upper 50 line. But the end of the story is if we get up there, I think that's a really nice opportunity to try to press some shorts, not only from where you are in price, from fib resistance and the monthly open, but also just from the technical formation that we're in. 50 has offered a really nice pivot, support, resistance, should offer some resistance on the rally into that region as well. Keep in mind you are marking some divergence into these highs. That being said, it could stay a divergence signal for another spike. As long as we stay below 71.30, 71.38, the rally starts to become at risk into that region. Why looking to sell the Kiwi exhaustion? Seems like should look for longs after this current pullback. Yeah, because I'm not really looking to play along beyond from here, Eileen. You're already pretty close to the weekly high. Look, on a stretch like this, even from a near-term scalper like me, I can't advocate trying to take a long. You've had a 4-day stretch of upside pressure. You're coming into the monthly open just higher. You know, yeah, you do have 30 pips here. Well, let me take a step back, Eileen. From a near-term scalp approach, you could probably take that swipe. Sure. If you get a long trigger, and specifically if you get back above 71, yeah, you might take that long into the key region of resistance against the session low. I got no problem with that. But I'm just saying moving forward, the broader trade is pretty bearish, okay? This was really strong divergence into the highs. And as it stands, we've already made a massive, massive reversal. Here's your opening range for the month. You broke the opening range to the upside, failed at the March highs, or excuse me, the March low day close, and then a quick reversal took you back below the monthly open, took you below the monthly opening range, puts a bearish tone on things. So for me, I think that the Aussie actually has a lot more downside to go. Aside from that, Eileen, and I don't want to start getting technical, but aside from that, look at what the markets are expecting from New Zealand. The New Zealand interest rate decision is not next week. It is the week after, but on the 11th, 94% chance for a cut. Okay, and again, if we take a look at what the expectations are for 10 months or for 12 months forward from New Zealand, markets are still calling for 57 basis points. So more than 225 basis point cuts still being called for in New Zealand. So kind of matches with the fundamental picture, kind of, suits well with what we're seeing in price action. I do think if you get one more stretch higher or a strong rally towards this region, you'd start to look for some resistance. For me, the bearish invalidation level is up here. If you clear 72, essentially, I think you look for, 73. I think you look for 74, 73.80, this region. I think it's a sheer breakout if we clear there. But for me, I'd rather be looking to take a little bit heftier of a position off of key resistance on the back of this rally. Says, okay, I see an exhaustion point coming up. You got it. Exactly. And remember where you are in the week, Eileen. I try to remind you this as much as I can. But yes, just because we've identified the trend doesn't doesn't necessarily mean there's a setup there, right? I'm never going to be really comfortable trying to buy near the weekly high. So if you're looking for a long position, I'd be looking for a pullback into slope support, former slope resistance, this median line, and that might offer a position to try to play the rally towards the 50. Okay, thanks for the extra details. Makes sense. My pleasure. Guys, thanks for everyone who joined here today in the room. I'm going to wrap things up here. Remember, Monday morning on Daily FX for our public webinar, Tuesday, Wednesday, and Thursday here on SB at 8:30 Eastern. Keep in mind, end of month, end of week, and the GDP data tomorrow from both Canada and the United States, as well as the BOJ later tonight. We'll try to keep you updated on SB Squawk. Best of luck trading, and have a great weekend, guys. See you on Monday. Cheers.